I'm thrilled to be back to the second best business school
Okay.
in America.
Well, it's an honor to be here with you. You've been here from View from the Top many times. You may have set the record, I think. So it's great to have this opportunity to have you back as part of our Business, Government, and Society initiative, which really gives us a chance to talk a bit more in depth about changes and challenges in the banking industry, the role of government oversight and regulation, the risk and opportunities you see ahead for the economy and sort of the geopolitical framework as a whole. So here we are, we're 38 days in to a new administration. Much of what we're hearing about is cutbacks on government oversight and regulation. But I wanted to start by sort of rewinding a bit to a time 2 years ago when it was really important to have the government step in, and that was the banking crisis that we saw in March of 2023. At the time, the Fed had raised short-term interest rates from 0 to 5%, trying to slam the brakes on surging inflation, and things started to break. Silicon Valley Bank, with $200 billion in assets, collapsed. It was quite a scene here in Town Square at the GSB, with students rushing to try and move their money from their startups to other banks in the moment. Soon after that, First Republic fails. Can you tell us why? What happened and caused these seemingly very successful banks to fail in that environment?
First of all, I am thrilled to be here, and I'll try to answer everything as honestly as I can. Rates were going up. Rates going up is always a danger sign, okay, for a lot of people. Remember, they went from 0 to 2 and then from 2 to 5. The 10-year went from basically 2 to 5. It shouldn't have been a surprise. I wasn't surprised. The Fed was surprised. They were telling you all that it was going to stay at 2%. And they were telling all the banks that. They were telling the world that rates were kind of going to be low forever. And when they started going up, kind of Warren Buffett's quotes, when the tide goes out, you see who's swimming naked. And so you saw it in a bunch of things. It wasn't catastrophic. The only catastrophic was those two banks and another one called Signature. And they had, Silicon Valley Bank and First Republic had two things. One was known and one wasn't really known. One was this kind of, we talk about uninsured deposits, but this is more like uninsured deposits that were kind of like a flock, very concentrated. So it belonged to all the venture capital companies. So it was the 1,000 venture capital companies and their 30,000 constituent companies. So when the venture capital guys sent that email out, move your money, all these people moved. And also all the people that worked those companies. And so you literally had a Silicon Valley Bank, $100 billion moving a day. That was unique, hadn't happened before. It's not the same as uninsured deposits, which is what some people think. And First Republic had essentially the same thing. I should point out, and the second thing which was known to everybody, any one of you who can read a balance sheet, is the interest rate exposure that Silicon Valley Bank had. They'd invested a lot of their money in 3% mortgages, in HTM, held to maturity. The difference in held to maturity and affordable for sale is in held to maturity, you don't have to market to market. But the world, I always tell people, forget the accounting. The market decides whether they think you're good or not. And what happened is their big portfolios lost a lot of value. And then when you said, what's the tangible book value of Silicon Valley Bank? If they had to market that to market, they had lost, I forgot, 75 or 80%. And that kind of caused the run. This huge loss of that, people run out. They hadn't pre-positioned collateral at the Fed, so they were unable to sell some of these bonds they had. They had a liquidity crisis. Government steps in. They stepped in very badly. They made a huge blunder, which I won't bore you with, which cost all of us $10 billion. Us, by the way, is the banks. FDIC is a mutual insurance company that the banks pay for. The government has never paid a penny. It's cost us $20 billion in the last 10 years alone. Okay, so this kind of moral hazard of mismanagement by the FDIC. And then First Republic in the same position. They let it go on for too long. We called up, Secretary Yellen and whoever and said, we can handle it. And we went back and forth, and we ended up buying that. We didn't have to do it. We didn't necessarily do it. We did it to help the system. Obviously, it had some financial benefit for us, and you're going to see some new branches around here as we try to replicate some of the things that they actually did do very well. And of course, the second we bought it, you never heard about it again. We just sucked it in, managed it, hedged everything overnight. But it did take 10,000 people working a year to do it. And when we say the government bailing out, the government had no idea how to do stuff like that. JP Morgan bailed them out. The other banks paid $10 billion to do it. And so that's what happened, and it does highlight people then come up with all the reasons they should change rules and regulations. If I had been running the FDIC, I never would have allowed interest rate exposure like that, ever. Sine qua non. The other stuff they might have missed, and there are other things you can be fixed about the discount window and how you have to pre-position collateral and some technical stuff. Had nothing to do with capital per se or so. And it shouldn't happen. I mean, two little banks basically go bankrupt. It's a whole big kerfuffle. We should have built a system that's more resilient than that, and it's not. So all this resolution recovery stuff, and basically, as I tell them, it doesn't work. So we should go back to the drawing board and build a system. If the bank fails, it's not a big deal. And there are ways to do it. Some technical, some may take legislation that you have a banking system which is, doesn't have a problem that causes it for everybody.
Let's talk a little bit more about that and what could give more resilience in the banking system. At the time, you mentioned sort of two key banks failed, but research by some of my colleagues here at the GSB suggested that there were hundreds of banks that were potentially in a similar position to Silicon Valley Bank and others in the sense of not managing their interest rate risk effectively, which calls some question into the regulations involved. But going back to that, first of all, if the Fed had not stepped in to ensure depositors and lend against the collateral they had,
the FDIC,
exactly. Do you think the problem has gone away? Have we recovered from that, or is it sort of covered up and festering?
When we bought First Republic, we were quite public. We said, this is the last domino, unless rates go up. And so we do what I don't know your academics did here. We have a heat map, and we do bank by bank, name by name. What would happen if rates go to, I'm going to say 6%? What would happen to the value of their real estate portfolios? What would happen if there was a recession? What would happen to their HTM? And so if that happened, a lot of banks would be in the red zone. So they were close to it, but not in it. Rates did not go up more than that, so they were kind of fine. But I still say if rates go up, and you have a recession, yeah, some will be in the red less. Some have been more responsible by raising capital, raising liquidity, being a little more careful, putting up reserves for commercial real estate. But if rates go to 6%, hey, folks, a lot of stuff is in the red zone. And there's most people don't believe it's possible. It is possible. I'm prepared for 8%. JP Morgan do fine at 8%. We don't run our company betting on interest rates, and so. But that if you had higher rates and higher credit spreads, certain private equity, certain private credit, there may be some insurance companies, there might be a bunch of banks, there are probably some things we don't even know about today that kind of comes out of the woodwork at that time. So yeah, that's what could cause a thing, which is think of stagflation, recession, which most people don't even put it on their radar scope. And another very important point, the Fed's the CCAR test that people do is one test. And it's basically a great financial crisis test. It's a full of shit test. It doesn't work. It doesn't make a damn bit of difference. We do 100 a week. If you think I care about their one test, but it lulls people into a false sense of security. And so the regulators are spending all the time on this other stuff as opposed to maybe what they should have. So what I look at, which I think people should always do is, and I think it's a good intellectual exercise, particularly for students, lay out all the possibilities, whether you believe they're true or not. Can we have a recession with 0% rates again, a boom market with 0% rates, a recession with 8% rates, stagflation? Can we have markets that actually go? Yeah, you can. And also think what would cause that? Because it makes you think a little bit harder about what are the factors, the future factors out there, not the past factors, which people focus on, but the future factors that could really affect this stuff. And that's called basic risk management. A lot of different what ifs and how can you handle it. And basically when you're a business, you want to be able to handle that regardless. So if we had 8% rates with the stagflation, JP Morgan would be fine. Our earnings would be down. I don't actually care about that much, but I can invest in the future. We can hire people. We can serve our clients. We don't have to pull back anywhere. So that is what I think they should be doing, and that's why I've always thought the CCAR thing was literally a complete misguided effort at risk management.
A key lesson, again, risk management and sensitivity analysis, something we talk a lot about here. I want to go back to sort of improving resilience. You mentioned that there are changes that could be made that could increase resilience. If you have 100 billion in assets and 90 billion in short-term debt, it doesn't take much to go wrong to put a bank in trouble. Do you think there would be some advantages in terms of reducing just increasing systemic resilience and reducing risk in the banking sector from increasing long-term equity capital?
Not really. The capital is not the issue. I know that you have some professor who think, 25%. We have 300 billion of equity capital and $1.2 trillion of loans. It is 25% of loans. We make $60 billion a year. Even the stress test has us losing money. We make money that year. It's not capital. There are other things which are, cause problems. And there should be nothing wrong with banks going bankrupt. That's the normal system. They're trying different things, they're doing different things, they're merging different things. So you're not looking for fail-safe, you're looking for a system that's healthy construction, deconstruction, or stuff like that. And so our system, I have a thing I put in my chairman's letter years ago called the spaghetti chart. We set up, not all Dodd-Frank was wrong. So I'm not arguing that. I'm not arguing that all regulation is wrong. But you got to take a step back at this point, a Byzantine system. We set up multiple regulators. There are 7 responsible for mortgages, 5 responsible for exchanges, 3 responsible for this. They can't even agree among each other what to do. So it literally cripples them. And then I look at this G-SIFI, which probably you don't know about. The calculation is completely asinine. CCAR doesn't work. Basel III was ill-constructed. And cutting across all that, resolution recovery is 80,000 pages long. It will never work. It's a complete waste of time. And so you have this system now, and what have they been doing for 10 years? Just adding more. Liquidity, LCR, G-SIFI, TLAC, this thing. So some of those things are good, but you should also ask yourself, what they missed was the opportunity to take a step back and say, how do you build the best financial? We have the best in the world, so just keep that in mind.
Well, on that point,
but they should have stepped back and said, what do we want? What do we want in the system? What do we want out of the system? How much resilience do we want? Do we want bankruptcies? Do we want more insurance? Do we want to favor small businesses? They never did any of it, ever. Nothing. No cost-benefit study, no analysis, no expected outcomes, zero.
Well, on that, you talked a lot about the micromanagement and the level of regulation on many activities. Going back to the previous point, if we had sort of more skin in the game, more equity capital, and as a result could back off on many of that micromanagement of the asset positions and things like that the bank is having, is that a good trade-off in your mind?
No, because the equity capital isn't going to fix any problem. And then you're creating huge arbitrage opportunities, which, look, if the regulator said, we want lending outside the system, so be it. Say it. I'm fine with it. We'll deal with it. We'll figure it out. But they don't. So if I have to hold, 2 times more capital than private credit, which is what it is today, then it belongs over here. And and in some cases, by the way, it's 5 times more because of insurance accounting rules on how they look at credit. Now, of course, is that going to last a crisis? And this is the other thing about the future. Will these insurance accounting rules that are arbitraging credit in the marketplace going to last when the shit hits the fan? They won't. And then you have another crisis, major insurance company go bankrupt, something like that. So yes, if you wanted to drive it out, go ahead. But again, if you look at these things, it was more about liquidity than it was about capital. And you also have to ask, what do you want the financial system to do? Banks are kind of, think of it as flexible capital. A lot of these other investors are not. The banks are flexible, and we're there in thick or thin, financing our clients, regardless of the environment. These people won't make a loan if things are bad. And you really have to be very careful when you design a system. What is it you actually want? And so hopefully we'll engage in some of those conversations sometime soon.
Well, you talked about private credit. Let me push on that a little bit. So, we've seen big growth there. We've seen sort of the Apollos, the Blackstones getting into private credit. We've seen the business development companies serving the mid-market. 2 things. One is when you look at those institutions, they are much more equity funded, so have more long-term capital backing them. So in some sense, we don't see that arbitrage, I think, that you were talking about, right?
No,
they have much more equity-based funding.
No, they don't. Some do and some don't. So the insurance companies don't. A private credit fund does. They might be leveraged, 2 to 1 or something like that. But what you guys don't see is there are multiple layers of leverage in there too. They borrow against those loans. They have subscription lines over here. They pre-fund some of these other investments. Literally, you don't all see all that stuff that takes place. But yeah, in some cases they're safer. Like an insurance company, in fact, does have, if you're an annuity company, you may have longer dated liabilities and you have better liability matching than a bank might have. But you have to ask, and that's fine. So some are, and they're quite good at what they do, so I'm not criticizing that. But is that what you wanted? 80% of the mortgage business outside. And I'll tell you another consequence, which I'd love you guys to study. Who looks at public capital markets here? Is there a professor who does public capital markets? We've gone from 8,000 public companies in the early 90s to 4,000 today. The 8,000 should have gone to 16,000. Okay, private equity's gone from 1,000 to 10,000. And I'm not, again, this is not a statement about against private equity. The question is that a good thing?